If you're an accredited investor, we'd love to talk to you. We've got just a few spots left in a B to A class value add multifamily deal we're closing on real soon. Now, if you've ever wondered how you can partner with our team and how you can be directly involved in the investing process and learn this business while you're invested, text partner to 41411. We've had a lot of activity also happening because I opened up my deal desk. So if you have an interest in potentially partnering with me on some deals, text partner to 41411. Now you'll immediately get our calendar link back when you text, and it's a link to set up a call to discuss partnering on our deals. Either myself or Robert will get on the phone with you and give you more detail about these opportunities. Again, that's text partner to 41411. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And today's episode is going to be a little different than normal because it's going to be topic-based. And I've got my CFO, Robert Ritzenthaler, on the call with us today. He's a CPA. He's done over $100 million worth of multifamily deals. And we're going to talk about passive investing in multifamily deals and actually utilizing that methodology to become a sponsor or syndicate your own deal. So, let's first talk about what is passive investment. Robert, welcome to the show, buddy.
Thank you. Good to be here.
This is actually the first time you've been on, right?
It is, yeah.
Oh, wow.
Yeah.
Wow.
I'll try not to screw up.
Yeah, right? No messing up. No messing up today. Now, we've been together quite a while, but it's long overdue. So, what is a passive apartment investment? Okay. It's basically getting involved in someone else's deal and hopefully sharing in the upside on that deal. So there are three different types of passive investments that you can consider. And really they relate to your investment strategy and what you're hoping to accomplish. The first one would be buying an A-class property, where the syndicator buys an A-class property. Could even be called a turnkey property. The second one would be, a distressed purchase, like a foreclosure or a very poorly managed property. And the third would be a value add situation, where somebody buys a property, improves it, and forces appreciation and improves the value. So let me talk about all three of these. And Robert, you chime in if I say anything out of turn here, but and we'll keep rolling here. So the first one I'm going to talk about is where someone buys an A-class property, and I will tell you a lot of times this is institutional type investors, and there's some advantages to A-class properties. There's no work required. I mean, these properties, are either fully updated or they're fairly new already, so they don't need updating. They're stabilized. They've got very high occupancy rates. And basically what a syndicator does when they buy one of these properties is they really just take it over and they just continue managing it. They don't have to do any renovations. They don't have to worry about tenant turnover. It's just not a complicated transaction to manage after the property closes. Now, typically, these A-class assets, they're fairly low risk because there's no risks involved in turning the property over, repositioning it, dealing with tenant turnover, the possibility of overspending, things of that nature. And so, they usually have the lowest returns. Okay. And that's the drawback is the returns are typically lower, and there's no, the upside potential is very limited because the only upside is going to be based on gradual rent increases based on market rent increases. So, the other possibilities that I'm going to share with you next, there's not much likelihood of a bump when the property sells because you're only going to get increased value based on again, market rents increasing. Would you agree with me on that, Robert?
Yeah, absolutely. I was going to say the other term that I often hear for these type of properties is it's a yield play.
A yield
So
play.
it's kind of folks that are looking for, let's say you're in Exxon and you've got a dividend, but you want to be diversified into real estate. Well, an A-class property with a nice amount of money coming off of it is equivalent in the real estate sector.
Okay. Great. Now, on the other end of this conversation is a distressed asset. Okay, and that would be, maybe a property that's in foreclosure. They haven't paid their property taxes. They're in trouble. Poor management. These are typically C- or D assets. Occupancies is lower. They've had maybe they're outdated. The property's outdated. They're having problems with tenants because they're not managing the property properly. They've probably let the maintenance go. It's called deferred maintenance. And usually what a syndicator will do when they pick up one of these, and in fact, one of my coaching students is in Cleveland right now looking at one of these, and I think he's going to pass on it just because it's just too much. And I'm really glad to hear it, actually. But usually these syndicators will take over the property. They'll try to turn it around. They'll stabilize it. They'll fix what needs to be fixed. They'll if they're doing it properly, they'll bring in the type of management that's needed to stabilize it. And then they'll increase the occupancy and hopefully the rental rates, and then do a sale. Now, the big advantage with one of these is the upside potential. Once the property's stabilized, the revenue on the property will increase, and as you know, any increase in the net income, the NOI, the net operating income, has an exponential increase on the value. And so there's if they do it properly, there's a large kicker at sale. Okay. Anything to add to that play, Robert?
Yeah, I was just going to say, as you mentioned, there's tremendous upside, but those type of properties typically require you to be there 24/7.
Right. I hadn't gotten into the drawbacks yet.
Okay.
And there's some definite areas for concern in one of these. These properties have higher risk. These types of deals have higher risk than any other deal you could do. And so and there are several risks. For example, if it's an area problem, for example, if it's a C- or D area, it can be very, very difficult to sell the property. For example, that Cleveland property I just referenced, I think the per door cost was $21,000, and guys are probably speed dialing on their phones right now trying to find that deal. And I'm here to tell you it's because of the area. So the only play there is a cash flow play because, it's tough to sell a D property. But the other risks are, and you could risk losing all your investment in one of these things if the operator runs out of money in the renovation process, if there's a management issue. There are a lot of things that could go the wrong direction. And so, and there will likely be a negative cash flow while the turnaround is happening. So, that will impact distributions on a deal like that. Anything to add? Did I miss anything on the risks?
Yeah, well, I was going to say, so you're also not, there's a reason it's called non-stabilized. You're not going to get stabilized financing either. So you're going to pay more for your interest costs. You're typically going to have a higher, risk in terms of your payments. So you're right, if something goes wrong, you're going to have to put money into the project. So there's not this idea that, I'm buying something, I'm getting cash flow, and as long as I put in my 20-25%, I'm good to go. There's a lot more behind.
So be careful with one of those types of syndications, my friends. Now, the third one, and the one that we talk about the most, the one, when we get syndicators on the show, and the ones that we do personally, are value add deals. And they're typically B or C assets that they are stabilized. And stabilized means they've got occupancy rates above 90% for the previous 3 months. That is, if you want to get agency debt. And they have an opportunity to increase the value, and typically a syndicator will take a year to two to increase the value, and then they'll either refinance or sell after 5 years. And now what I'm talking about adding value, I'm talking about improvements to the exteriors, improvements to the interiors, maybe new appliance packages, maybe new plank flooring, new faucets, maybe putting in crown molding, things that will bring the look of the units up and make them competitive with other units on the market. And and by virtue of that, you'll be able to get higher rents. And again, if you get higher rents, that goes right, goes right to the bottom line, and you increase the value. Maybe you do some things outside. You put in a playground, or you fence in an area for a dog park, or maybe put some covered parking in the parking lot, or put in a barbecue pit or something. There's lots of ways you can increase value and increase the amenities even, and increase the appeal of the property. And I'll tell you, I feel like this play has the lowest amount of risk, and for several reasons. Because it'll have the highest returns and the highest potential to have a kicker, at the end. And I think these are, in my opinion, the safest. And here's the reason why. Firstly, you're buying a property that's stabilized already, so it's got income coming in. Okay, it's not like the distressed asset that doesn't. It's not stabilized, so the income is inconsistent and lower. And so while you're turning around the property, you still have cash flow. And then there's still an opportunity. Like, we're doing a deal right now in Dayton that it's a B plus property, and once we're done adding value to it, in fact, that's closing pretty quick, like here in short order. And by the way, we still have some slots open in that deal for accredited investors. If you're an accredited investor, make sure you text partner to 41411, and we'll tell you about that. But that's a B asset, B plus, that will be A when we're done, and it's got rents that are $200 below market, which is very, very unusual in a market area that's very, very strong. So we're really excited about that deal. But that's the kind of stuff that we like. We like an asset that we can add value to, that and reposition by making improvements and improving the management, improving the revenue, doing everything we can to decrease expenses. And then, that's the kind of asset that will pay, an annual return to the investors, both the active and the passive investors. And it'll also allow for, a nice bump at the sale or refinance time. I mean, if you're going to sell it, then it'll be a bump at sale. And if you refinance it and everybody gets their money back, and then it becomes a legacy property to hold on to for cash flow. And so, that's anything you want to add to the value add, this third option.
Yeah. Well, I was going to say, of course, that is our favorite. We like it, just as you said, because you've got both cash flow and capital appreciation. At the high end, you have a cash flow, but you don't really have much appreciation, and you've got more risk there. And then, of course, at the low end, you don't have the cash flow, but you might have a big bump when you go to sell it. But this is a great combination because you do get both, and it really allows you to accomplish two things at the same time, get a little higher return. And, of course, if you have the experience to know what you're doing, then you can execute and realize those returns. Right.
Now, what I want to share with you guys now is what I think is a foolproof three-step process to becoming your own syndicator and sponsor. And I have students that are doing it this way, and it's a way to become credible and become a sponsor and ultimately a syndicator. And let me explain it to you. Now, obviously, you can go out there and do it yourself. If you find a sponsor that trusts you and will work with you, you absolutely can go straight into that and just jump in the lake yourself. But you're going to need to build your resume regardless. And this process that I'm going to share with you works very, very well. And basically, what you do is you invest passively in somebody's deal. And this is how a lot of syndicators get started. Because by virtue of investing in somebody's deal, that goes on your resume. Okay, so you're starting to build your experience. Now, in addition to having that on your resume, if you've got a syndicator that will kind of put his arm around you or her arm around you and walk you through the process while you're doing the acquisition, the due diligence, the the purchase, the management. You're learning the business as you go. Okay. So that's the second big advantage to this process. So you invest passively, and so you're building your resume, you're learning the business, and again, if you've got someone that's acting in a mentorship capacity, you're learning. I said that. So then what you do after do you want to add anything to that?
I think you got everything. Yeah.
Okay.
I think
all right. Then the second step would be to be the key principal on your own deal. And if you've got a good relationship with the general partner on the first deal, they'll likely co-sponsor you because they know you. They know who you are. And then you can be a key principal and a co-sponsor on your own deal. And then ultimately after that, you can actually sponsor your own deal. And this is a great progression into this business. And it doesn't have to take that long. It could take 6 to 12 months to do all of this. Okay. And that's like in our deals, that's what we try to do. We spend a lot of time educating our investors so they can utilize, the relationship with us as a platform to invest actively and be their own KP and be their own sponsor ultimately. And it's just a great framework. And I'll tell you, when you do it this way, there's some big advantages. One of them is, typically you'll get a better interest rate when you elect to do it yourself because you've got that track record. You've got even if it's passive, you're still the bank will look at that as experience, and you're in a much stronger position with the lender. And if you've developed a relationship with someone like us, then you're good to go when you want to do your own deal. So do you want to expand on that?
Can I throw something in there? Yeah, I was going to say, I think that something really key to understand here is that the agencies, Fannie and Freddie, and even HUD being more difficult, they require a certain level, as I know that I'm sure we've heard here before, they require a certain level of experience.
Right.
And so it's very important to have that resume built up when you get to that point, because if you want the best terms, the best rate, and the ability to close on that property, you're going to need to have that experience. Right. So going straight into the sponsoring side, while it is possible, generally it's going to have some challenges, whereas if you really want to build it the best way, you go through this 3-step process as a limited partner, preferably alongside of somebody who's doing kind of a mentorship program, because then you really learn the business.
Right.
And you're not
and a lot of syndicators, will consider doing that if you've developed a friendship with them, and we do it because I have an educational platform and that's just how I roll. So one other thing that I want to bring up is that investing and learning are not silos. Robert, in fact, you want to chat about that for a minute?
Yeah, absolutely. I was just thinking that the process of becoming a sponsor includes being a limited partner, being an investor, and also going to somewhere to learn. So you're both getting mentored and you're going through a course. So I often, I talk to people, and it's not a mutually exclusive process. So if you want to be your own sponsor, I would absolutely encourage everybody to be a partner in a limited, as a limited partner, with a sponsor who's going to do some mentoring, knows what they're doing. You can gain by, walking alongside of them, but then also going through a course and learning the material from you might say more of a textbook perspective is also really good.
You have to do both. You have to do both, and I don't care if you do it with me, but you guys have heard me say it a million times, don't dabble. Dabblers get crushed. You cannot just, you can't shortcut this process. You need to learn the business, and I wanted to give you one great way that I've seen it done. I've got coaching clients that are in hundreds of units that are now syndicating their own deals using this exact same methodology. And, but they're my coaching clients. So they went through my course, they did coaching. And again, I don't care if you do it with me, but make sure you do it as part of this process. I'm glad you brought that up, Robert.
I was going to say one other thing too, just by way of example, is one of the co-sponsors on the deal up in Ohio, he has about 1,700 units as a limited partner. So he's been gaining that experience working with different people, and now he's stepping over into being a co-sponsor.
Right.
So
He's co-sponsoring with us. So he did the exact same framework as well.
Exactly. I mean, a lot of value.
Framework. Yep. But the key piece here is you've got to educate yourself, textbook educate yourself as well. That's the second point there. And now let's talk about, Robert, some of the ways that or some of the things that a sponsor has to bring to a deal, the way they add value to a deal, because if you're new and you're just getting started, some of the things we're going to talk about here are things you're going to have to learn and ultimately bring to the table yourself. So like for example, finding deals and identifying what is a deal, right? Being able to underwrite the deal and, really determine if it makes sense, really determine if there's an opportunity there, make sure that, that no mistakes get made. Okay. So, and then obviously after a deal is identified, you have to negotiate and create a win-win, hopefully, and then once you've negotiated the price, then you've got to actually even negotiate the contract, which can have pitfalls. And by the way, you guys always bring in an attorney when you're writing a contract on a larger deal. But then you have to come up with a business plan for the asset. You have to come up with, what are you planning to do with some detail? You're going to reposition, how are you going to do that? Over what period of time? How many units per month are you going to turn over? What are you going to do to those units? Maybe, what are the exterior plans for the property? So you've got to come up with a business plan, what you plan to do. Did you want to add anything to that?
Yeah, I was just going to say all of what you're talking about, I think for the most part talks about underwriting. And I feel like we oftentimes gloss over that. I think you can learn the underwriting, the Excel spreadsheets and that kind of thing, but there is an element of experience that goes into that where it's almost like if you're starting a technology company, I could put together a pro forma that looks great on paper and maybe says, oh, I'm going to do $5 million in business next year. But the person who has the experience is the one who I'm going to trust.
Well, they're going to know if some of those pro forma expense column or expense line items are realistic. They're going to know if the vacancy factor that you put into the deal is realistic. If the the repair and maintenance line item that you have for each unit is based in reality, just from their experience. And that's why this methodology that we're talking about here it's a safe, proven way to do this. Can you do it yourself? Absolutely. Come see me at my live event in August, and I'll get you going on that. You can go to multifamilybootcamp.com. I think we still even have early bird pricing, so come see me for that. But the bottom line is, this way is a safe, if you've got a mentorship relationship, is a safe, prudent way to do this. Some of the other things that a sponsor is going to be, obviously totally ingrained in is the due diligence process, making sure you look underneath every rock, making sure every question gets asked, making sure every agency involved with that property gets called, that, that you've done looked at the demographics properly, that the market is improving, like on that Dayton deal we were just talking about. It's a submarket with the lowest unemployment rates in the country, with, and you want to make sure that the jobs are growing. You want to make sure that the population is growing, that income is growing. And this is, again, some of this, it's pretty straightforward. You look it up, but some of this comes from experience as well. So it's really important that you don't make mistakes, especially in this hot market. And so the due diligence piece is important. Make sure that you carefully analyze all the leases on the property. Add some things to this for me, Robert.
Yeah, well, I was gonna say, actually, leases is a really important thing. A lot of folks kind of gloss over that, but those lease terms make a big, big difference when you close on that property, and now you are on the hook for whatever's in there.
Right.
So you may have anticipating charging pet rent, and all of your leases say that you can't charge pet rent.
Right.
So, again, you can go back, you can rewrite it, and you can reposition it, but little details like that.
Well, there's a lot of detail when you're doing the due diligence on a property.
Yeah.
And, in my course, we've got probably one of the biggest and best due diligence checklists in the business. But the bottom line is you need to have a checklist and make sure that you look underneath every rock. Even in my free book, I've got the beginnings of a pretty good checklist in there. But then the next thing is you've got to line out the financing. And, the financing requires a lot. And so, we deal with it every day, and, there are a lot of detail, a lot of, very regularly you have to reconstruct if the financials weren't done well on a property, you have to reconstruct those. So there's some nuances there with securing the financing. And of course, the lender is going to look at three things. They're going to look at your net worth, they're going to look at your liquidity, and they're going to look at your experience. And that's why, aligning yourself with the sponsors is a great way to do this. And then, then you get into the managing the asset. And, we're a proponent for third-party management in these larger deals for sure. And there's some great management companies out there, but you want to, really know how to screen them as well. And then really one of the biggest areas that we see people make mistakes in is actually performing and doing the reposition and not going over budget and not allowing too many units to go vacant that impact the cash flow, and just really managing that reposition process properly. And again, that's another big advantage of aligning yourself with someone that's done it before. So anyway, those are some of the ways that a sponsor adds value. A good syndicator, and I've had lots of good ones on this show. And if you guys if you want to check us out, please set up a call with Robert or I, and just by texting partner to 41411. Would love to chat with you about deals that we've got coming up. And if you're accredited, even if you're not, go ahead and set up a call with us. But the deal we've got right now is accredited only. And what did I miss, Robert?
I think you got it all the way down to the sponsor side of things. I mean, that's right. That's the biggest piece. That's the goal at the end of the day.
The bottom line is, I know many of you listening to my show want to sponsor your own deals. You want to be your own syndicator. Here's one way to do it safely and frankly, quickly. Again, would love to see you at my live event if you can make it. And that's multifamilybootcamp.com. Thanks for listening, guys. Take care.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.
Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws.